We were talking about this recent rise in retail sales, kind of stalling out last month. The jury's still out on what the Fed does with interest rates from here on out. So let's bring in Frank Roche, an economist here, on whether the economy is moving in a direction where rates will start going up. Do you think it is at this point or no?
I don't think there's basis in the economic data to suggest the Fed should raise rates, except for that unexpected non-farm payroll data point we had over a week ago, which laid into Janet Yellen's conversation that said if we get boosted employment, we'll go on rates. So this retail sales number does not support raising rates.
Because the GDP figure the week before, which as we've talked about from a political perspective, seemed to get buried by all the other news that was out, would have been a number, say Donald Trump could have jumped on because it wasn't a strong number, but we're at jobs. What is going on with jobs? Is it as strong as that seemed to indicate it is?
No, and when you look at the details, you dig down and get some granularity on that, you find the job quality and the wage quality of that job growth was not sufficient. Was not a basis for the Fed to raise rates. Retail sales, the same thing, Colin. Retail sales have been weak for the whole year, averaging 0.3% per month since the start of the year.
Isn't it funny to see the market at record highs and we come in every day and there is, I was using the word disconnect, but it's a weird market. Weird, you know.
Yeah, well, they're juiced by the Fed, by free money, right?
Yeah.
It's algorithm trading models just boosting stocks higher on the back of free money from the Fed. Bad news.
People don't feel better though, you know?
No.
And like I was saying to our guest before this, nobody comes up to me and hey, did you see the Dow? Like, I know people years ago they would.
That's right.
Excited about it, but there must be a reason for that.
Well, there is. It's because the economy's not doing that well. The bad news is good news. Good news is good news for the stock market. The stock market does not reflect economic fundamentals in terms of corporate earnings, in terms of corporate ratios, and how we evaluate companies. And it's not part of the puzzle right now. This is all about central bank action, free money to the banking system, and flowing all into equities.
So let me ask you this. We talk about the stock market a lot, saying that it is quote-unquote grinding higher. It's been somewhat boring, but it's been going up, right? On the economy, is it sort of like, it's all right, no big deal? Or are you, when you say the economy is weak or is not as strong as we think it is, are you worried?
I am worried. We're moving towards recession, as is the Eurozone, as is Australia, as is Canada, as is Latin America, of course, as is Asia. We're looking at growth rates. Remember, those are annualized growth rates on a quarter-to-quarter basis. We're looking at 0.1%, 0.2% per quarter. This is not robust growth.
Well, we're really moving towards recession. That could be, I ask you partially because that could certainly have a political impact. We're in an election year. When are we heading into a recession year?
Well, it's a matter of what the central banks do. To the extent the central bank continue to prime the pump and push liquidity into the system, we stave that off. We've had $9 trillion of fiscal stimulus, so to speak, over the past 8 years, $4.5 trillion of free printed money, and we're getting 1.2% annual growth. The problem is that the underlying economy is not performing well. Capital stock is not sufficient, our trade balance is bad, our debt and deficit picture is bad, our immigration picture is bad, our regulatory picture is bad, our education picture is bad.
Come on.
I'm telling you, these are all factors minimizing the potential growth of the U.S. economy.
Okay, so to be serious about it then, you're right. If you're right, then those are very important factors. How does it play out? Because after we went through what the disaster of 2008, a lot of people look back and say, I should have seen this, and this. And I mean, is that what you're looking at, that these are signs of some sort of an event or something's on the way?
Well, there's a whole bunch of things that could cause an event. As I mentioned to you in the break, Deutsche Bank alone out of Germany has such a difficult situation on their hands in terms of liquidity and the derivatives portfolio that we could have a credit event that could start this whole ball rolling again like Lehman in 2008. But beyond that, the economic data, look at the numbers. It reveals a weakening economy over time, and it has been this way for several months.
I'm sorry to say that Frank's message, which it could have been more positive.
Yes, I can bring some positive.
It's not going to get any better as the show goes on. You know, one of our guests later is Mark Faber.
Oh, okay.
Who probably thinks the world will end good about 3 o'clock this afternoon. It's coming up. Gloom, boom, doom reports. And he will continue to ruin your weekend if he can. So, which Frank started to do. So, thank you, Frank.
You're welcome. The reality is tough sometimes.
Well,
but we have to bring this data to our attention. Those that aren't paying attention to the data are continuing to lie. So they need to be aware of this. The central bank is aware of it, and they're going to pay attention to it in September.
You're right, though. It is an important conversation, obviously.
Yeah.
Thanks. Have a good weekend, all.
Thank you very much. Great to see you.
Frank Roche.